Hello, future billionaires. Welcome back to another episode of the podcast. This is another great one for you. We keep just coming out with some great episodes. I got to say, I just enjoy all these recently. They're kind of really specific about the market right now. So we brought on Jorge Abreu, who is CEO of Elevate Capital. They're a very big multifamily operator. He's been in the space for 16 years. He's seen cycles in and out. And this was a great, kind of heart to heart conversation.
So this guy, not just an operator, but he's actively acquiring these properties. So, he's seen all the changes in pricing and has really got some warnings about debt and how debt is changing and what's going on in the market, differences between how everything's happening in Class A versus Class C and the differences. So wealth of market information here.
Yeah, it's really a deep dive. It's some things we've talked about at a high level, but hearing it from someone with boots on the ground, experience with a huge portfolio, he's seeing what's happening in real time was really, really valuable.
And from a guy who's been through 2008. So
Yeah.
we love it.
No,
And
definitely.
he is. So we ask him, is this the same? So I'll let you listen.
Yes. And at the very end, he also shares a very unique strategy that you're kind of excited about and teed him up on finding a very unique value add in multifamily that a lot of people maybe have not heard of. So stay tuned for that. And as always, we appreciate you listeners. If you're enjoying the show, please share with someone that you think would get value out of this. Rate this and review this podcast if you would. It really helps us get the word out and share with more people. If you haven't yet, check out the website at thebillionairepodcast.com for all the information you need to join the investor club, get notified of new deals, and do the reviews and everything there. Thanks so much for listening. Enjoy.
Let's hear from George.
This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Welcome back to the Invest Like a Billionaire podcast. I am your co-host, Ben Fraser, joined by fellow co-host Bob Fraser. And today we're joined by a good friend of ours, Jorge Abreu, who is the CEO of Elevate Commercial Investment Group. If you haven't seen Elevate or heard of them, then you must have been hiding under a rock, because these guys have been very active in the multifamily space. We love George and his team. And super excited to have you on the podcast and talk about multifamily. This is, on a lot of investors' minds. Multifamily has been great for the past decade plus,
but everything's changing, right?
Everything's changing, and so
will it continue to be or not? What's going on. So George is a wealth of information and knowledge. So can't wait for this.
Yeah. So George, give us a little background on you. Those that may not know you, you have over 6,000 units in your portfolio currently. Been in real estate over 15 years, exclusively multifamily. You're a one-trick pony, but pretty good at that trick. So give us a little more background on you.
Absolutely. Well, first of all, thanks for having me on here. We've known each other for a while, and we've talked quite a bit about real estate in the past couple of years. So yeah, nice to get on here. As far as myself, so I'll take you back to, I guess, when I started in real estate. So that was about 16 years ago now. Decided to jump in and do real estate full time. At that time, I was working for UPS in the engineering department. So I've got a electrical engineering degree. In getting that degree, I knew I didn't want to be an engineer, but I went ahead and finished it off.
It's still a great experience, right? You
Yeah.
learn, it helps you, but
For sure. So started doing single family, actually, is what I started with 16 years ago, and really liked the fix and flips part of it. Started a construction company to scale that side. We were doing maybe at the max about 50 fix and flips per year, and then some other wholesale deals. And then I've been through a cycle. So, what's happening now is it wasn't the same thing that happened in '08 for sure. Fundamentals are different. Everything's different. But during that down cycle, we did buy and hold a lot. So, things were really cheap, and the fix and flip wasn't really there, but we were
It was a
the
fix and not a flip.
right, right. So bought some small multis, bought a bunch of single family stuff, and then I honestly didn't like the management part of it. So I didn't like to have to go and collect rents and hear all these stories and all that stuff. We didn't quite have enough where, at least I didn't think it made sense financially to bring in a third party management company. So pretty much what happened is when the market heated back up, I sold everything and went back to fix and flips. And then finally got introduced to multifamily syndications. And man, I just did not look back. Like, it was instant scale, one deal buying 100+ units, a lot less transactions than what I was dealing with on the single family side. And we've been pretty busy past few years, acquired around, over 7,000 units, exited another 1,500 or so. So, still pretty active right now, maneuvering through the market, and pretty much the debt has become really difficult.
Yeah, talk about that a little bit. So you had kind of a stated goal. You wanted 10,000 units, on your quest to continue scaling, but it's really kind of put a pause on that, right? Because as a lot of people are seeing, a lot of these deals aren't penciling, and it seems there's a pretty big gap between the bid ask of these apartments going right now in the market. So it's difficult to make deals happen. It's difficult with the changing debt markets. So what are you kind of seeing, and what's kind of caused the slowdown from your perspective on acquiring?
Yeah. So, I mean, going back the last couple years, I want to say, I don't know the exact statistic, but I mean, from what I saw, maybe 95% of the loans that were getting done were bridge loans because the rates were so low.
And just because we want to bring all of our listeners in, what's bridge loans, and just walk us through that.
Yeah. So a bridge loan is kind of what it states, right? It's supposed to be a bridge between a temporary loan and a permanent loan. You're supposed to take the time it takes to stabilize that deal and then go and get a permanent loan on there, a more of a agency type loan. They used to be maybe around 2 years were the terms, but then when the market kept heating up, I mean, I know all the ones we got on were 5-year pretty much term.
So typical bridge loan, people know about debts like a bank debt or whatever. So what are the characteristics of bridge loans? Let's say when you were doing this, 2, 3, 4 years ago, and what are the characteristics now?
Yeah, the biggest difference is your bridge is going to be adjustable rates, and your permanent is going to be a fixed rate. The adjustable rate didn't seem like a problem when the rates were so low,
Right.
right?
They've been low for so long, right?
And then you also
and
have
bridge is private investors. They're
Right.
not banks usually. They're just hedge funds or private equity companies, right? Rates are a little higher usually, would you say, or
they usually, but it started trending the opposite.
the opposite way? Okay,
Yeah.
and sometimes they'll give you more on higher LTV, means they'll loan more against the value of the property. Is that right?
Definitely. They're going to give you off of the loan to cost versus where most agencies are just going to go off loan to value.
Gotcha.
So big difference on leverage for sure.
And so what's happened, rates have gone up, and are you seeing the bridge lenders getting more conservative now? They're not as willing to go as deep into
Oh,
the
absolutely. I mean, there's some that have shut the doors. So some of the smaller guys, they just their lines are getting called and they can't do it.
So they're shutting down, they're getting more conservative. Are you seeing the loan to cost ratios going down more conservatively?
Absolutely.
Wow. So literally debt market is completely changed. And that is because that was so you said 90% of the deals getting done out there were using bridge.
Yeah. Yeah. So you had a lot of, so I want to say 2018, maybe even going into 2019. You did have a lot of agency getting done, a lot of agency debt. But what happened, and a lot of people saw this issue, is where they got stuck because they had a large prepayment penalty, and they couldn't seize the opportunity of the market spiking up and they couldn't sell their properties. So then that's when everybody started going towards bridge and the loan, with the rates being under what agency was offering. Yeah, I mean, I want to say, like I said, I don't know if 90% is exact, but it sure felt like that's what everybody was using for acquisitions.
Yeah, and from a pure financial standpoint, if you can get higher leverage and lower rate, that's going to allow you to be more aggressive as a buyer because
Mm-hmm.
less equity down, your debt yield is lower, so you can afford a lower cap rate.
Offer
But
higher yields, higher returns to your investors if everything goes well.
right,
Right.
and now that it's changing, and it's becoming less more conservative. It's interest rates going up. It's making it a lot harder to pencil these deals, right?
So you can't borrow as much against the value of the property, and the rates are higher. All of a sudden, deals aren't penciling anymore at the same level. And so, but so we're seeing it's a lot harder to get deals done. What are you seeing around the pricing?
Yeah, so I was about to say that. So there always seems to be like a delay, right, from your seller. And we were dealing with that for a bit. I think the sellers are starting to catch up and realize that if they want to sell right now, they're gonna have to take less. That's the only thing that's gonna. I don't want to say it's the only thing. It's one of the things that can fix acquiring a property with these rates right now. The other one is getting a little creative with your capital stack as well, and filling some of that gap with maybe private equity or preferred equity.
Yeah, interesting. So, I mean, you're saying there's kind of a gap. So the sellers had in mind, hey, this is what I'll be able to, sell it for now, price adjustment. I mean, it seems like too, a lot of sellers may just hold on and wait, right? So if they're not in, dire straits, they may just, well, now that the right time to exit. So it's taking a lot of product off the market as well if they don't want to sell for lower than they're expecting.
For
So
sure.
are you seeing fewer bidders? I know for a while there, it was like a bidding war. It was like a feeding frenzy,
Yeah, yeah. I mean, we're seeing a lot less. We're negotiating, believe it or not.
Wow. For anybody that's not familiar, it was insane. I mean, we're getting outbid by $1 million or $3 million at a time on these things, and with bids that were already pretty aggressive. When you're looking, trying to get returns, and you're looking at there's not that much meat on the bone, and then we get beat out by $3 million. We're going, what is going on? And I think a lot of people got the multifamily bug from a syndicator point of view. Like they attended a seminar about being a multifamily syndicator or something, raised some capital, and now you got the money, you got to go spend it. But those days are that capital's evaporating, and those deals are running out. So now maybe it's getting a little more realistic.
Yeah, I think same thing I saw back in the other 2008, 2009. The buyer pool begins to shrink. You've got to be able to raise more equity now, right? Since you're getting lower leverage. Also, your lenders are becoming a lot pickier on who they're going to lend to.
Mm-hmm.
So yeah, I mean, now, there's some deals we're looking at where we're the only one looking at it, or there's only a couple other people looking at it, and it's like, okay, well, your whisper is this, we're going to offer millions under, and we're waiting, sitting and waiting on some of this stuff.
So think back to 2008. What's different with what's going on now than what you saw happening then?
I mean, you have inflation, right? Back then, the inflation wasn't anywhere near what it is now. I feel like you still have really good fundamentals, and the economy is, for the most part, other than what the Fed is pushing, they're kind of wanting the economy to do bad, right?
But it isn't.
Yeah,
Not yet. It is. Yeah.
correct. The economy's still fighting them off. So it's definitely different. Honestly, if it was not for the rates, I mean, it would still be a really hot market. So
Yeah. Yeah. I mean, 2008 was fundamentally, it was a real estate and a banking collapse.
yeah,
And this is not that, right? This is not, this is, I actually, I got one on you. I went through the dot-com crash, and that was different. And real estate prices softened, but it wasn't a real estate and banking crisis. It was really a stock market crisis, so everything's interlinked at some point, but 2008 was fundamentally, it was real estate speculation and shoddy underwriting that that drove these values to excess and with speculation, this simply doesn't have any of those characteristics. And as you point out, inflation is a massive tailwind for real estate, right? If you want to really get a free ride, and coast, erect your sail into the inflation tailwind. And that's what real estate is doing. So, there's going to be long term, there's just going to be plenty of demand for this. And in my view, at least, inflation is not going away anytime soon.
Yeah. Talk a little bit about, George. I mean, we're talking about the kind of debt markets, the capital, structuring of these deals, but on the other side of this equation, multifamily, to your point, has very attractive fundamentals. We're seeing housing affordability just plummet right now. Those interest rates are going up and home prices haven't taken a huge hit yet. Maybe they'll plateau or even decline, but it's pricing. I think the year-over-year difference in affordability was 40% less.
Right.
So
all of a sudden the homes are now out of range. What do people want to live? So the people have to live. What are they going to do? They got to rent, right? Are you seeing strength in the rental side of the business?
oh yeah, it's
Yeah.
nothing like I've seen before. I mean, the increase on rents, and you've got a lot of people coming towards renting for. So I'll give you an example. I just saw this morning. Somebody bought a house for $400,000 roughly last year, same time, and they bought it today the same price. Just with the increase in rates, they'd be paying an extra around $750 a month.
A month.
Yep. So, even if the prices drop, your rates are still up there,
prohibitive,
right?
yeah,
And
comparing to leasing. Yeah.
So it just creates demand for multifamily, and one or the other is going up, right? As long as there's demand increasing, which we're seeing, that there's still a shorting, still a pretty huge housing shortage, pretty much anywhere in America. So we're seeing the debt stack has significantly changed, and so, but one of the things that we've seen, and one of the things, we're going to be talking about, in a future deal, we found a little unicorn here, with a assumable debt, right? And it's a Fannie Mae loan at 3.49%. So that completely changes the equation, right? All of a sudden it's assumable 9 years assumable debt at 3.49%. It's like, okay.
yeah, I mean, it's crazy, right? Last year, somebody would have told me this property has assumable debt. I would have been like, no, thank you.
Who
right?
cares?
Right.
Yeah.
Move on to the next. Now I hear assumable and I'm there, I'm all over it.
So there's still good deals out there. In fact, and what you're saying, there's softness in the market. So there's good deals yet to be had, and including unicorns like this.
Yeah, we're submitting offers weekly. I mean,
That's awesome.
we've definitely changed our criteria. I do think.
What's your criteria? How's it changed?
Yeah, so we were very value add driven, right? And we've got the in-house construction, and we're not scared of heavy lifts. I don't
Heavy value add, where you got to do a lot of work, in the property. Gotcha. Yeah, it's a real fixer upper. Yeah.
So I'm not saying we're not doing those anymore. Period. Just if we're doing that, it's because we're getting it at a really, really low basis.
Right.
Where we're seeing more, or at least easier to add value, is more of the A class, especially straight from the developer. We've done several now, where they're more concerned about occupancy and not really pushing the rents. So we can easily come in, do a couple tweaks, and just kind of take it to the next level. We're looking at that's a lot of what we're looking right now.
So when you're looking at that, the kind of, it's always all the sponsors flash their big IRRs. Here's what we're going to get on this deal, right? But it's so important to look at what's the risk adjusted return, right? And through COVID, these heavy value add deals have suffered a little bit, not only from just difficulty in getting supplies, and the supply chain has disrupted that flow. Labor's been very difficult to get. And so you have all these timing issues, and you end up taking a lot more risk in construction and repositioning assets. If you're going from a C to a B or a B to A minus or something, and you're trying to get these higher returns, but in these kind of more class A deals, it's more of just a operational tweak. You're not taking undue risk from construction, from supply chain, from the labor markets, from having to prove out a brand new business plan. It's, let's add a little bit of extra revenue by adding parking or add some other amenities like dog parks. Let's do things that are a lot lower, sweat off your brow, but can have pretty similar amplifiers to the bottom line.
Yeah, we pay a lot of attention to what the average household income is in the areas as well. And for the most part, these are higher class residents as far as their salaries and what they're making. And whether we're in a recession, we're heading towards a recession, whatever you want to call it, I feel like they're going to struggle less versus somebody in a C class. And we've seen some of that in some of the C class stuff already. So
You're seeing literally more trouble with renters paying.
correct.
Yeah,
Correct.
interesting. And it makes sense because especially in inflation, it's the lower income people that are the most hurt by it, right? If it's painful to fill your tank, then you're gonna. I got to drive to work or I got to pay my rent. Which am I going to do? Well, driving to work is probably if it really is that bad, you have to make that choice. Then yeah. We're seeing, tell us if you're seeing the same thing. We're seeing a difference in demand and pricing for class A versus class C properties. And we're seeing, the cap rates have moved quite a bit for class Cs. Are you seeing the same thing where it's much softer?
Absolutely. I mean, it had the margin between A class and C class had got compressed so much. That's one of the reasons that we're kind of, staying away from the C class right now. I just feel like pricing wise, it's going to take the biggest hit for sure. So if you're buying at the height of the price on a C class and you think you're going to add all this value, but if you can't for whatever reason, I mean, I don't want to be in that position.
Or you already say you do add the value, but because you bought it at the top of the market, you go to sell it, the market's not going to price in that much premium anymore. So you actually achieve your business plan, but now you can't sell it where you thought you could because cap rates have gone back more to the mean.
Okay, so before we lose everybody, multifamily 101, all right? So A, B, and C class, the difference is primarily age, right? So the C class are like vintage, 70s or 80s typically, right? And so typically they need more updating, more modernization, that kind of stuff. That's the main difference, right? And is age. And C class, and historically, C class sold at a higher cap rate, meaning they were less expensive relative to their net operating income, right? That was historically. And then what happened during the COVID era, all of a sudden the C class caught up where they priced is almost, not far under the A class. And it's like, and that's what you're pointing out.
Looking for that value add, right? So everybody was going towards there.
Everybody was bidding these things up. And now it's coming back more to, okay, they're reflecting the price that they really should be. And what we've seen during this run up, we saw a bunch of, I think, smaller syndicators with value add stars in their eyes would go buy this C class and think, I'm going to fix it up. And they budgeted they went in and budgeted their rehab, unit rehabs, but then they blew out the rehab budgets, right? Because whoever experience. You can't hire the workers. All of a sudden the workers are wanting 50% more and lumber went up 7x. And it's like your budgets get blown. Well, meanwhile, they've raised a fixed amount of capital. They're out of money. And so what are your choice? Well, let me sell it back to the market as a second version of a value add to somebody else, right? More value to be added. So we're seeing a lot of deals blow up, right? Because just this calculus. And so prices are really coming back to normal.
Well, I think it also takes a lot of work to operate these, especially the C class with the delinquencies and just like you mentioned, they're older, right? So there's things hidden and there's issues that are going to pop up. You're going to have issues with the boilers, with the chillers, with the roofs, with, cast iron, sewer pipes and whatnot. A lot of mediocre or even bad operators have been saved with the market. And now that's not there anymore.
Right.
You really got to be able to be efficient and operate the property better.
So as you kind of shifted from, more heavy value add to more lighter value add Class A properties, what are other factors you have to look at in underwriting that are maybe different from the Class C? What makes a really good Class A, right? Because, these generally go for a higher premium, but if, you're in a high growth market or you're next to, great job growth or, give us some examples of how do you look at it differently? And what are the factors you mentioned median income? So how does that kind of play into, you have some kind of bright line metrics you look at when you're looking in these markets for these deals?
Yeah. I mean, the first thing we look at is the rents and then other income as well. How much can we really push on the rents and are there other income that we can make by, bundling the internet and adding in the internet or just adding an amenity fee. We do that by looking at the comparables in the area and see what other apartments are charging. And we look at like I mentioned, the average household income, how much can our residents really afford before it's just, we're asking for too much. Right.
Right.
So really pushing the income is the number one thing and seeing how far we can push it. And then, the expenses, what efficiencies can we add and where can we cut out some expenses if we can. We have been able to find that most developers are not great operators. They want to build these and they want to get out of them. They don't want to hold them long term. So usually we can find a lot of savings on the expenses and a lot of items that we can add for more income.
Buying direct from the developer. Yeah.
It's interesting. I mean, it's interesting to look at the math too on generally these Class A properties have a much higher unit count. And if you're going and, to your point, one of the deals that we really looked at a while ago and ended up investing in with you guys was a Class A deal. And one of the value add plans was bundling internet and having that as a part of, the package. And I forget the specific number, so correct me if I'm way off base here, but maybe something like $50 to $100, somewhere in that range. But you add that across 300 units per month.
It's real money. I mean, it's real NOI boost,
and divide that by your cap rate that Class A is generally going to trade at. That's millions of dollars of value from one little thing it's not going to be a budget breaker, right? For these.
Well, and they're already paying internet. You're just changing who they're paying it to.
Right.
It's
So
not
that
even
same apartment you're talking about, we just started implementing is we added a smart thermostat, a smart lock, and some USB plugs. And now we're charging $50 to $75 extra for those units. And, that's.
And how much is that,
Right.
that cost? Just rough numbers to put those things in. I mean,
Oh, God.
1,000, right?
I mean, we're talking about no more than $600, $700.
Okay. So
Yeah.
you basically make money within what, 5 months?
Yeah.
Or
Yeah.
8 months.
Insane.
Yeah. That's pretty crazy. Yeah. What other things? So I'd love to hear from you, kind of going back to younger George and been through different market cycles, different strategies. What are things that you've learned as you've kind of scaled to this level? I think that's something that's so interesting being where you're at, because there are so many syndicators that are coming onto the scene and seeing what worked maybe in the last cycle or the last few years. It's probably not going to work going forward, like we're talking about with these Class Cs. And how have you kind of shifted your perspective? What are the things that maybe have been underweighted by, younger, glossy-eyed beginners that they need to be overweighting when you're looking at a deal and you're digging through the due diligence, or vice versa?
I think I mentioned it already a little bit, but just, what it's really going to take to execute some of these business plans, the work it's going to take. Like, some of it might sound nice on paper and in your pro forma, but are you ready to actually do the work that it's going to take to get it there? And do you have the team, right? Are you setting yourself up for success or for failure, really? This is it's going to be a great few years for some good operators, and then it can be a really bad couple years for some that aren't ready for it. We're ready. We're ready to seize the opportunity and really pick up as much as we can. I feel like we didn't buy enough the last time in the down cycle, so that's one thing I've learned. We're ready. We're ready to keep buying and buying as much as we can.
So what are ways that you're kind of preparing, when you're making acquisitions? Obviously, basis is the end all be all. If you make a good purchase on the front end, you can weather a lot of storms, right? But outside of basis, what are things that, if we do go into some turbulent territory over the next 12 to 18, months, what do you think as an operator, what are the important things to be aware of as you're navigating, challenging circumstances?
I think number one is debt and capital stack, like how you build that, right? Number one is preserving your investors' money, right? You never want to be in a position where a bank or private equity can take over your deal, because then your investors aren't their first priority, right? So I think that's number one, being smart about that, not getting over leveraged and not getting into a bad loan. And then number two is location. I know everybody always says real estate's location, 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 but it really is, especially now, like you want to make sure you're picking locations that have strong, good growth and fundamentals, and that a recession is not going to wipe it out.
Let me jump off there for a second. So your strategy in 2008, what you did is you just held, right? You weathered the storm, and ultimately storms do what storms do. They pass, right? And the key is just the key is to have staying power, right? Is to be able to stay in the game. And the way you stay in the game is by managing your debt. The way you get creamed, and to your point, it's where you're over leveraged or you can't service your debt. If you can't service your debt, you lose the debt, and they will take your property and wipe your equity out, right? So the key is managing your debt service. And so, I would say that's really the most important thing operators need to be doing right now is coming up with a plan B, which is a 10-year plan, right? Because in 10 years, at 8% inflation, literally at 8% inflation, the value doubles in 10 years, right? So a $20 million property is literally a $40 million property if it just keeps pace just with inflation. So, and if you put in, $2 million to buy that $20 million property, that's optimistic, but all of a sudden it's worth 22 million. Your $2 million become 22. You did super well. The key is to ride that wind, you have to be able to service that debt and stay in the property, right? And not get wiped out. And the key is debt service, debt service, debt service. Pay attention to the debt and have a plan B, which you can flip your business plan over, and that was my big problem with the bridge debts is they had, 3-year expiration dates with floating rates, and you have to refinance in year 3. Well, what happens if you can't? And that was, it looked to me like a bug looking for a windshield. You know, it's like this is, if everything is great, then it's going to be great. But there's a lot of risk here. What if you can't refi? What if you don't have enough debt service to refi? What if the rates are higher or the cap rates are higher when at the moment you want to refi? Well, now it's just massive risk. So I think debt service is really the way forward, is to manage that. And as an investor, to understand, what does the debt stack look like and the terms of the debt.
Agreed. 100%.
Awesome. George, well, thank you so much. I don't know what the other thoughts, but I
have one more
good
question.
nuggets. Yeah.
So, okay, on paper, right? I love paper, right? I love paper profits, and big ideas. So you look at you look at hotels, they're on fire sale right now, right? No one wants these things, a Comfort Inn or something, and you get these super low prices for hotel properties. You get these super high prices for multifamily. Hey, it's kind of the same. Let's got rooms. Let's just, boom, do a paper switch. Is that real? I mean, so, and you've actually done some of this, right? So
Yeah.
you end up with kind of a weird product that no one wants, or is it a good product? Are you excited about this? What's the real scoop on hotel conversions and hospitality conversions?
I'm excited about it. I'm really excited about it. In certain markets, right? I think it needs to be the right market where you're running out of affordable housing, and pretty much what somebody can do is downsize, right? And they can go into these smaller units, studio units, and we're able to get them at a really low basis, like you mentioned. So that's I originally started by saying that we'll still look at value adds and we'll still do them a heavy lift if we're getting it cheap enough, which we are on the hotels. It's quicker than building from the ground up, right? So if I'm going to do a new development, so it's somewhere in the middle between a renovation and a new development. But I can get them done much quicker than I can a new development. So I'm excited about it. We're about to close on 3 of them in the next couple of weeks.
Really? You've completed more than one, right?
No, this is going to actually be our first 3 that we do.
The first. Yeah. So we have yet to see if you can make a product that the dog food that dogs will eat, right?
I mean, we've built from the ground up. So, I mean, we trust that we can get the construction part of it done with no problem. And then there is case studies in the same market that have done it and been successful.
And they were, wow. Yeah. I mean, to me, that's, if you can crack the code on that, it seems like just an easy way to make money.
Yeah.
And like everything, it's repurposing unwanted real estate into what's wanted. It's a service, right? It's doing a service to the nation here, or the city, right? Creating housing, which is what they need, and getting rid of hotels, which is what they don't need.
I will say, do not close on them without getting them rezoned, though. So that's, we've been working on that. So we've got them all rezoned now, and that's why we're closing.
Very good.
Yeah. Great point.
Then you're just stuck with a hotel.
Nobody won't. Awesome. Well, George, this has been fun. Always get some good nuggets in talking with you, and appreciate you coming and sharing the wisdom, and looking forward to some of these opportunities that are kind of coming up. So, you're out there looking, we're out there looking, and, stay tuned. We've got some fun, exciting things coming together. So.
Absolutely, man. Absolutely. Looking forward to partnering with you guys.
Awesome. Thank you so much.